When we looked at the house example, basically the conclusion was as long as your profit is anything greater than zero, even if it's $1, you'd be better off adding debt because it increases the return on equity for the investor of the house. So what about a company? Is it the same thing? If you have net income of $1, is that going to be enough to make it worthwhile to add debt? The answer to that, unfortunately, is no. It has to be greater than zero, but it's probably going to have to be much greater than zero because there's other things to consider. The two things that I really didn't consider that I mentioned in the previous example was that that there is going to be an interest cost to debt, and taxes also exist. So these are going to have an impact on our analysis. So for a company, the same thing. The one thing to consider is that the investment by the shareholders is going to be different in both scenarios, just like it was for the house example. And then the net income will also be different in both scenarios because you'll have to adjust it for interest expense after tax interest. Now, interest is tax deductible, so taxes actually lowers the interest cost, so that's a benefit, but you're still going to have some interest cost even after tax. Okay? So essentially what you're going to have to say is that the company is going to have to create a positive net income after it covers this interest expense. And net income is going to have to be not just greater than zero, but greater than zero by enough to cover that net interest expense amount. And before I get to the actual comparison of the two, I'm going to talk about a couple of terms, basic terms from accounting. EBIT is earnings before interest and taxes. This is a good proxy for how much is a company earning from its operations. If you take out the fact that it's financed one way or another, whether it's financed by debt or not. So this is just earnings from operations before you've paid any taxes on it. And then there's earnings per share. This is a very important number for shareholders. It's calculated by net income that was earned during the year, divided by the number of shares that are currently outstanding for the company. The reason this is important is because this is what you want to maximize for a shareholder. The bottom part of that equation is just their investment. The top part is the earnings. So it's similar to the ROE that we did in the house example. So I'm going to do the exact same scenario or a similar scenario from the house example. And we just have two different financing ways. So we're going to look at a company A, and we're going to consider what happens when it's financed with no debt at all, or whether it's financed with some debt. It's like the mortgage in the house. And the things that are going to be different in this scenario, as we talked about, is the number of shares outstanding. Or another way of saying is how much equity did you have to raise? It's going to be higher in the no debt scenario. So just in the house, you put in more equity, same thing. If it's a scenario where we're looking at debt, it's going to be lower because part of your financing is through a loan. So as a result, the after-tax cost of interest is zero for the no debt solution, but it's going to be higher for a company with debt because you're going to have to pay interest even after you get the deduction. And since you have net income, which is going to subtract out the interest, it's going to be higher for the company that has no debt because they don't have any interest expense. The company with debt, unfortunately, is going to have a lower net income. So does that mean that adding debt is actually hurting things in this case, and it's better to have a scenario with no debt? Not necessarily. There is a break-even point at which this makes sense. And that point really comes to comparing the earnings per share of the two companies. So you don't want to compare the dollar income because both of them required a different amount of investment from the shareholders. The no debt solution required a much higher level of investment, just like the no debt solution for a house. And as a result, the ROE was what we used to compare it. And in this case, the earnings per share is sort of like an ROE. It's the investment, the profit that they earned on the investment. So the break even, if we take the earnings per share of A with no debt, and you compare it to the earnings per share of the company if it actually had debt, then you want to see which one of those is higher. And when those two are equal, that is where the break even actually occurs. And we're going to do an example and calculate that to illustrate how that principle works.